Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
There is a team that backs up Robert Curtis in his role as a financial advisor. That team includes researchers. And Robert's guest is Sam Miller, the Director of Research and Marketing at SEIA. Now, Sam works with the company's investment committee and contributes his expertise to portfolio construction and investment selection. So, Robert, tell us about the focus of your discussion today.
Yeah. Thanks, Patrice. Absolutely. I do have a team, a pretty extensive team that backs me up that not everyone sees all the time. We always talk about our people, our practice, and our process. So the team is integral in that process. And I wanted to bring on a guest today who's Sam Miller. He's the Director of Research for our firm. So you may not always see him or hear from him. Sometimes he goes out on materials, but we do engage him in client conversations when it's needed. And I read a lot of the research reports and materials that come out from our research department, along with others that help me formulate my opinions and provide advice and guidance to clients. So wanted to bring him on for a conversation about some of the areas we're thinking about at this time. We're recording this. This is November 14th, 2022, just to put that into context for folks. So welcome, Sam. Why don't you go ahead and introduce yourself a little bit and then maybe talk about your role at our firm and with a team such as mine.
Thanks, Rob. Happy to be here today with you. And as you mentioned, I have the privilege of leading research efforts here at SEIA. And there's a team of folks behind me, more than a dozen at this point, of highly qualified investment professionals. And our team's mission is to essentially bring best-in-class investment strategies to our financial advisors and their clients to help them build portfolios that stand the test of time. So that can include portfolios of traditional stocks and bonds, or in certain cases, it could include things like alternatives or other types of strategies like that.
Great. Alternatives is something we've been using a lot, and I've introduced a lot of clients to, but I still think that may be a new term for a lot of folks, or one they don't fully understand. Could you share a little bit about how we view that, what alternatives means, what you're seeing, how they've traditionally worked, why one even would consider that, maybe all that?
Exactly. So it can be a confusing buzzword that you might hear from other advisors, from the media and other places, and rightfully so. Historically, it's been an area that has gotten a bit of a bad reputation because it can oftentimes be associated with higher fees, lack of transparency, lack of disclosure, lack of registration with the regulatory bodies. But in simplest terms, we really can categorize it into two different areas. And I like to think of it as follows. So one group of alternatives would be something that you could add to a traditional portfolio of stocks and bonds and either improve the diversification by reducing your equity exposure to the markets, or maybe reducing your interest rate risk on the fixed income side, and really serve as a portfolio diversifier. So that's the first category of alternatives. The other one would be more for special situations. So something that you're looking to deploy from a tax perspective, or something else that's really seeking to solve for a very specific situation. So keep it as simple as possible. One bucket, you've got diversifiers. The other bucket, you've got special situations alternatives.
That's great. And then I like how you put that, but a lot of your role in research and diligence is to sort of ferret out the things that might not be appropriate, or where the fees or the structures don't really work for our clients because we're fiduciaries in this process. So we talk about, I guess, some of the processes you use to help develop the lineup or the alternatives that might be worthy of consideration for going into portfolios. How do you separate sort of what's best in class and what you think is fiduciarily responsible versus some of the things that probably just you wouldn't recommend or wouldn't work for a client?
Sure. So philosophically, we talk about being a fiduciary, and ultimately we've got to feel strongly about what we put in client portfolios and what we recommend to clients. It's got to meet certain thresholds for us. And in the alternative space, where there is this sometimes lack of transparency, it requires us to go the extra mile, and sometimes the extra 2 or 3 or 4 miles to get to the bottom of what an investment is, how it works, what the incentives are. And so I would say for a typical alternative, it takes a lot more time and energy to get to that level of comfort than it might take for a plain vanilla ETF or a mutual fund. But that's all in the benefit of our clients, because from a alternatives perspective, we want to stay in the middle of the fairway. We don't want to run the risk of things going sideways, especially for our clients in their portfolios. So there are some strict rules that we have to abide by. We're not going to invest in the latest flashy thing. Like, think of the things that have had trouble recently: meme stocks, SPACs, crypto. We were largely avoided a lot of those things. And maybe a year ago, we had certain clients saying, well, why won't you do that for me? And, maybe it was frustrating at the time, but in the grand scheme of things, I think everyone's pretty happy that we've sidestepped a lot of those problems that have plagued certain areas of the market in the last year. And that's just an example. And a benefit of our process is the fact that we've got a checklist that we've got to adhere to. We've got a discipline, and it largely helps us to sidestep a lot of these issues that can come up.
That's great. And I have a lot of confidence and rely on that process as well. I love how you phrase it, the middle of the fairway, because times I have played some golf, usually the middle of the fairway is a pretty good place to be, unless there's really a great reason to be outside of it. It keeps you out of trees and all kinds of obstacles. And that's the way I view it too. For most clients, we're looking for core exposure, and we're looking to reduce risk and things that might diversify their portfolio, but bring additional elements in that could be helpful. Like in a year like this year, 2022, it's been a very challenging year for markets, both stock markets and bond markets, in the wake of rising inflation and interest rates. What are some of the spaces you see? I know private real estate, things like corporate lending. Maybe talk about a few of these alternatives, what they would look like, and how they do provide this diversification and lower correlation. And just to throw one other concept out there, talk about, I guess, institutions or endowments or entities like that would typically have a pretty decent percentage of their overall portfolio into allocations like this. Go ahead. Take all those if you would.
We've paid pretty close attention to what the institutional players have done historically, and certainly pay attention to what they've been doing recently. Think of the big endowments out there. And that's not just because I certainly respect the work that they all do. That's absolutely the case, but also because more and more these days, folks in our space, high net worth individuals, mass affluent, actually have access to some of the same or similar types of vehicles. And that wasn't the case 10, 20 years ago. So it's not just because I like following what the Yale endowment's doing. It's also because we also have access to some of these things. So, think about how an endowment invests. It invests, in perpetuity, invests for generations to come, and it can take on some illiquidity risk. It can afford to tie some assets up for long periods of time. And most of our clients don't have that same ability to take on illiquidity, but some might if they're planning for generations to come as well. So there are certain similarities there. So we certainly pay close attention to how those types of institutions are allocating assets. But then thinking about some of the specific sub asset classes within alternatives. You alluded to a couple of them. They've weathered the storm relatively well this year compared to more liquid options. So private credit through the end of September was down in the mid single digits on average for private credit type vehicles. And then real assets, thinking about real estate, commodity oriented alternative funds, those are up about double digits through September. Those tend to do really well in a inflationary environment. So to the extent that investors came into the year with, even a small sleeve of alternatives, it really helped to weather the storm in the more traditional stock and bond markets. And so does that mean they're always going to hold up that way? No, but I think there are opportunities as we go forward as well. So if you can think about carving out a 10% sleeve for alternatives, it can make sense for a lot of clients. And maybe that sleeve needs to be bigger depending on your specific goals and objectives, or maybe it should be smaller. But think about maybe starting to carve out that sleeve and benefiting from the diversification properties of these alternative assets.
That's great. And that's how I view it as well. We're starting to see that. I thought of a little bit of an out there analogy, but I remember hearing, years ago when the human genome was sequenced, and I believe it was just Steve Jobs got his whole genome sequenced, and it cost millions of dollars. And I don't know how long ago that was, but now I think you can have that done for well under $1,000. So a lot of people can afford it. It's almost like this. It's kind of like it's moved down, and we do the diligence, but these types of alternative investments could find a place in a normal portfolio. You talk about like an endowment being a much longer time frame, like the Yale endowment or Princeton or something like that. But in actuality, what I see sometimes is I have second, third generation clients. We might be talking about several generations down the line, that responsibility to grow, to protect principal, to continue income. In some ways, I see some analogies, and I'm curious if you see it that way as well. But we could be talking, 100 years in some cases through multiple generations. We might not even be around to serve them; someone else will be. But that corpus will still be there, and those needs and those future generations will be there. So that's just what comes to my mind, having dealt with it on the front lines.
Yeah, absolutely. That's the beauty, I think, in working with an advisor like yourself, is understanding what the goals are for the specific client relationship, and understanding, are they thinking 5 years ahead, or are they thinking 50 or more years ahead? And that really helps to shape, the portfolio construction and the asset allocation piece.
Yeah, 100%. And so, yeah, I invite anyone, if you want to have a conversation. And a lot of times I'm bringing it up with clients, but we can always go deeper in that space. I wanted to pivot a little bit to another area that comes up with a fair amount of regularity. This would be folks with concentrated stock positions. I would say relative to, say, their whole portfolio value or their net worth. They might have one stock or sometimes two stocks that are a very disproportionate percentage of their portfolio. And they might have held that for a very long time and have a large unvetted, what we call unrealized capital gain. In other words, if they were to liquidate that and diversify, that could be very costly from a tax perspective. So there's multiple strategies, but I'd like you to delve into some of these strategies. And then also, it seems kind of obvious, but you might want to expound on this single stock risk and why. Give some garden variety examples of why that can be a big deal. It's if someone has Honeywell or something, it doesn't seem like a big deal, but there've been a lot of household major names that all of a sudden, General Motors, General Electric, their situations changed dramatically, and it got viewed very differently. So, kind of teeing up on, I'd like to maybe ask you to comment on some of that space.
Yeah, I think you're absolutely right. And unfortunately, to the extent there's a single position in someone's portfolio that represents a larger and larger piece, what we often notice is there's an inverse relationship in their ability to think clearly about it. So if I've got 20%, 30%, 40% of my wealth tied up in a single name, the decision to either hold it or sell it or wind it down kind of becomes clouded. And it really helps to have an unbiased third party help you with that and navigate through some of those challenges. But you're right. Yeah, think about just 2020, a couple of years ago, there were plenty of household names that experienced a bankruptcy. Hertz, JCPenney, Frontier Communications, Advantage Rent-A-Car, Pier 1 Imports. Those are, pretty strong brands at one point in time. Arguably, how strong they were in 2020. Obviously, in hindsight, they did experience a bankruptcy. But at some point in time, there were plenty of people who held those stocks and felt really strongly that they were in a high quality name just based on the brand itself, and all those experienced a bankruptcy. So that goes to the point of, just because it's a strong brand, or maybe was a strong brand at some point in time, doesn't mean you should have an outsized position in your portfolio. And that's something we can certainly help with. I think there's a couple solutions to think about. Maybe no one best solution, but there is a spectrum, and we can certainly walk you through the pros and the cons of each of them. The first one being what's called an exchange fund. And without getting into the nitty gritty details, it essentially allows someone to exchange single stock risk for market risk. So basically, let's say you've got $1 million in Microsoft and it's an outsized position. You could potentially contribute that stock into the exchange fund and receive a basket of securities in exchange for that. So instead of having your risk tied up exclusively with Microsoft, it would be market risk. And that market risk might be the S&P 500 or the Russell 1000 or something like that. And then after 7 years, you can withdraw that basket of securities from the portfolio, and you don't have to pay any taxes until you sell. And then a third one, which is probably the most recent addition in the last several years, is what are called qualified opportunity zone funds. These came out as a result of the Tax Cut and Jobs Act back in December of 2017. This was an effort to stimulate the economy, and specifically different communities around the U.S. Every governor of every state designated certain opportunity zones. We've got them all over the place here in California. And the whole idea was to encourage long-term private investment in underserved communities. So the way that it works is, let's say, again, you've got your $1 million in Microsoft. It's a highly appreciated position. You sell that Microsoft stock. Normally, you'd have to pay a capital gains tax on it on your next tax filing. But in the case of qualified opportunity zone funds, as long as you roll that gain into a qualified opportunity zone fund, that tax is deferred until you file your 2026 tax return. So you get tax deferral up until your 2026 taxes are filed. And then on the new investment in the opportunity zone fund, as long as you hold it for 10 years, it gets a step up in basis after 10 years. So again, it's a somewhat complex vehicle. I'm barely scratching the surface here, but would love to have a conversation with you on this versus an exchange fund, and then a handful of other strategies that we could deploy as well.
No, that's great. And boy, as you describe these, if you're listening to them, I've dealt with a lot of situations where people have these concentrated stock positions, and often they've had it for many, many years. So it's an ongoing concern. Maybe it's held up okay, but you're right. It could fall off. Just look at Meta or Facebook this year, right? I mean, it's down a lot. It's moving in a very different direction. So a lot of times, if that is in your portfolio, I'll just really make this an invitation or to anyone who's listening or knows somebody who might be in a similar situation. We can have this kind of educational conversation of the alternatives, and it might be piecing different pieces of the strategies together, but so that you know what they are, and that you certainly, most people do not want to just implement and do this themselves. They don't have the experience to know all the different strategies, how they work together, all the pros and cons. We can work from purely an advisory capacity to really spend the time. We've gotten on the phone quite a bit with clients. I can bring Sam on. We have this conversation. We go what feels right for them. Maybe they take action, maybe they don't. Probably more often than not, we're just simply educating on what these strategies are. But it's coming from a purely advisory perspective, one of advice, of guidance, of fiduciary, of stewardship. No one's trying to sell you anything other than, our process is very sound and these are very sound strategies. Whether or not they're exactly right for someone in particular, that's to be determined. But this is what's done, and we have the chance to assist a lot of folks in this type of situation. These are the strategies and the best practices that we see on a regular basis. So I brought Sam on to a number of these calls and always look to him as a member of my value-added support team. So if that comes up, or if that's something that is of interest, just always let me know, and I'll certainly reach out if I see that in someone's portfolio. Sam, any other thoughts, I guess, for just strategies for clients at this time, maybe high net worth folks, or just folks in general that you're seeing in research, sort of some salient points as we start to kind of wrap up that you might want to put out there?
Yeah, I think I would just highlight within our high net worth solutions group, which is called our private client group. Those types of folks obviously have access to all of our alternatives, but then also some of our higher net worth solutions like charitable giving, trustee services. Those types of things obviously become more and more important for that sort of cohort. And we're certainly willing to partner with you on that as well.
Yeah, 100%. We see that charitable giving, sometimes people giving away these concentrated stock positions as a way of reducing it down, or we loop in their CPAs. Other times we see high net worth folks that want to borrow substantially, right, for business purposes or for other reasons. This is a holistic wealth management practice. We see all these things, and we've got a pretty comprehensive toolbox of solutions. But it all starts with conversations, and it's done in a very custom way to find out what's right for the individual. So we'll have these conversations, and we're very comfortable spending a good amount of time up front just to really talk about, to educate clients, to give them the pros and the cons, and then if it turns out it's something they're interested in, really show them what that would look like, what it would take to implement something like that, and how that would go. So we'll walk them through those steps. So Sam, I thank you so much for coming on. We've worked on a good number of cases, and we'll have a lot more to go. But this has been a great resource, and I just wanted to introduce you to folks and let folks know there's a lot behind the team. It's not simply residing with me and some maverick talent. There's a lot of folks I bring on and into the process. So we're always learning, and we're always adopting best practices and putting those into play. And thanks for coming on, and we really appreciate it.
My pleasure, Rob.
And Robert, if listeners want to continue this discussion with you, how can they reach you?
Yeah, I would say, all the simple methods, but probably the best thing is to simply send me an email. I'm rcurtiss, CURTISS @SEIA.com. That would probably be best. You're welcome to call my office. My assistant Stephanie can help set up a time to chat. I'm on the social media as well, but probably a simple email would be best.
And all you listeners, of course, follow this podcast for the newest episodes and share with others. Thanks for being with us.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Alternative investments provide investors with exposure to markets and investment strategies that cannot be assessed through traditional fixed income and equity markets, such as real estate, commodity, or natural resources. Investing in these investments is speculative, not suitable for all clients, and intended for experienced and sophisticated investors who are willing to bear the high economic risks of the investments.